Good afternoon and welcome. My name is Brian Schubel and I'm the Director of Major and Plan Giving here at Salem State. Thank you so much on behalf of Salem State University and Salem State University Foundation for joining us for what will be a very informative hour on recent tax law changes, what that means for estate planning, and ways to support Salem State now and in the future. It's my pleasure to introduce one of our true champions, Joanne Ricciardello, who hails from the esteemed class of 1968 and later received an honorary degree in 2019. She and her husband, Phil, created the largest active alumni group outside of Salem. And the Ricciardellos have hosted alumni and friends in Southwest Florida for over a decade. The couple are members of our Crosby Society by including Salem State in their estate plans, furthering their commitment to our students. The O'Keefe Sports Complex is named a tribute to Joanne's late father, and the Ricciardello Atrium, located inside the O'Keefe Sports Complex, is named in honor of Joanne and Phil. Joanne helped lead the class of 1968's unprecedented 50th reunion campaign. And here she is to tell her story.
Hello, and welcome to another great webinar sponsored by Salem State University. I am Joanne O'Keefe Ricciardello, a longtime graduate of Salem State College, and today a very proud member of the University Alumni and Foundation Board, currently serving as chair of the Fundraising and Engagement Committee. The Foundation Board, in simple terms, promotes and protects the funds that are so generously given to the university. Also, my husband and I are members of the Crosby Society through our legacy gift to Salem State a number of years ago. When Phil and I got married in 1969, we moved out of state. And fortunately, we reconnected with the university here in Naples, Florida, nearly 15 years ago. When we toured the university campus with then President Meservey, we were hooked. The life-changing opportunities for students provided by gifts like ours made our decision easy. It is really gratifying knowing that your final gesture of goodwill is enabling students to attend Salem State University, receive an outstanding education, and go on to successful careers in their chosen fields. I sincerely encourage you to visit the campus to understand how proud we are to be involved with the university. Now, it is my pleasure to introduce today's presenters. John Pastore graduated from Salem State University in 1994 with a degree in business. He stayed connected to his alma mater as president of the Salem State Foundation Board, the Salem State Alumni Association Board, and the Bertillon School of Business Advisory Board. John is a private wealth manager with over 20 years of experience, and he is a founding member of Integrated Financial Partners. Richard Austin is the Executive Director of Business Owner Solutions and Family Oriented Office. He serves as a national resource to integrated advisors and their clients. With over 20 years of industry experience, Rich consults with high net worth clients and business owners on estate planning, charitable planning, business succession planning, and tax planning strategies. I hope you will enjoy today's presentation.
Thank you for that long introduction. We appreciate it, Joanne. And welcome, everybody. I'm so glad that you're here with us today. As a member of the Alumni Association, as well as the Foundation Board, we all know the importance of giving to Salem State. And today, it's Rich and I's mission to have you walk away with a better understanding of how the taxes work around charitable giving, as well as some updates from the recent tax changes, or maybe say the changes that never happened. So it is my absolute pleasure to start off with Rich Austin, who is my partner at Integrated. And what's unique about Rich is that you'll find that he's a blend of, tax experience, where he used to, lead the Lincoln Financial the national committee to assist the advisors, and moved over to Integrated, where he is now an intricate part of our high net worth group, where he helps high net worth families make important decisions around their estates and gifting. But you'll see that his blend of tax experience, coupled with estate planning, having a JD, and his wealth management experience, all blended together, make him uniquely qualified to speak today. So, Rich, why don't I turn it over to you to get the slides started? And
thanks a lot, John. I just want to say good afternoon to everybody.
Thank you. And we'll talk a little bit about creating your legacy as we begin. When we founded Integrated Partners, it was our goal to have a place that advisors could come and do independent work for their clients in a way that was holistic and unencumbered by products. So when we talk about creating a legacy, I know we have a unique group today. We have a lot of youth in our group, which Rich and I are so excited to hear. We've also got some people that are kind of midway through their profession, and we've got some people in retirement. We'll make it a point to try to speak to everybody. But when we talk about creating a legacy, I think it's different things at different times. So we have people that are just starting out. It's making sure that you have things that, you have documents in place, and that you have an idea of what your giving is. It kind of grows as your estate grows. And then it gets more complexity, and it's that level of complexity that creates opportunity. And what's so important is that you build something not only for your children, but just as a memory of the achievement that you made as a person to your community and to the things that are important to you. So with that, we'll go to our next slide, and I'll start by asking Rich a question. Hey, Rich, when we talk about a level of complexity, why is it so hard to start the process? What are some of the barriers to starting the estate planning and the gifting process?
Yeah, that's a great question. So I think for a lot of us, and for our clients, there's so much complexity around financial planning, around, looking at all the different components from investments, risk management, understanding your whole financial picture. But then you layer on top of that, tax laws. And it's not like tax laws stay the same, they change. We're going to talk a little bit about that, today, and how that's going to happen. And maybe it impacts some of you. But then we kind of look at our charitable goals too, and what, the complexity, and that's a great word that, John, you is complex. And, things are complex because there's multiple disciplines that kind of come together to, where you try to have to make a decision, but where you finally get the grasp of what's going on. And then there's a change, the tax laws change or something else changes, and you've got to kind of get up to speed on it again. So understanding the tax laws, and then kind of understanding your goals. What are your family goals? And how does that coordinate with your charitable goals?
So there's our good old friend, the Bill. I know we have some younger people joining us today. They might not recognize it, but for those of us who grew up with Schoolhouse Rock, there's our good friend, the Mr. Bill. And thanks for bringing him back for us, Rich. Rich, a lot of us have been hearing since October that there were some big tax changes coming, and that we had to brace ourselves for possible increases in our taxable situation. I know that there were some big changes with that, and it doesn't look like it's that way anymore. Rich and I actually had an event a few weeks ago that he found out about 30 minutes before the seminar went off that the tax changes weren't going to happen. Rich, is that right? And maybe get everybody up to speed with what happened with the Build Back Better Act and where we're at and how that might impact their lives.
Yeah, so the Build Back Better Act, a lot of it's in the news. It's always referred to as the infrastructure bill, and and it goes back even more further than October. I mean, you think back, about a year ago, we were starting to get some information that there's going to be some tax changes that are going to happen. the government needs to raise revenue to spend money. So, and how do you rate? The easiest way to raise revenue is through increasing taxes. And what are some more popular taxes? Income taxes, capital gains taxes, estate taxes, taxes on, business entities like C corporations. All of those proposed changes were in the, in the December, the drafts that were put forward, late 2020. Into June 2021, they were still in there. It wasn't until October 28th of this year, just a couple of weeks ago, that they were taken out. So this poor little guy, the bill that was trying to get passed, trying to make his way from the House to the Senate and ultimately get signed by the president, he's a little tired. He's been going back and forth. There's been a lot of negotiating going on. And so there's certain provisions that haven't been included. So we can all take a sigh of relief and know that, the highest income tax bracket is not going to go back to 39.6%. The capital gains rates, the highest rate of 20%, it won't double. It'll stay at the brackets, where it's at right now. I'll kind of go through that later on. For those of you who have set up trusts in the past, maybe a life insurance trust, that's the most typical form of grantor trust. And there was, for some of you who have never heard of a grantor trust before, it's a tried and true strategy that John and I have used, with our clients, for, it's been used for decades. And, the most typical one is where the client's life insurance policy is held inside of the trust because it avoids the estate action when a client passes away, and it's the right place to own it for some clients. So making changes to grantor trusts was a big deal, and clients are reaching out to their CPAs and attorneys, to figure out how this impacts them and what they should be doing going forward to, for their estate plans that are in place. And it wasn't until November 3rd where we received like a new proposal from the Rules Committee in Congress, that all these proposed changes were taken away, that they weren't in there. So you had a little bit, and everyone was, in our world, it's a little exciting, and a lot of you are probably like, not as excited, but you kind of like, you're talking to the attorneys, you're talking to the CPAs, and everyone's like, did you see those proposed changes in there? And everyone was double and triple checking to make sure, because there was a lot of plans and designs that were being put into place in anticipation of the changes. So that's a little sigh of relief. And also the estate tax exemption wasn't going to be cut in half at the end of this year. Some other changes that were supposed to be included that weren't included was for you business owners that have a flow-through entity like an S Corp and an LLC, the Section 199A deduction, which is essentially a 20% deduction on flow-through entities, which has been in place for a couple of years and will sunset in 2025. So no changes to that currently. No elimination of the step up in basis at death, which is basically if you ever, had a loved one like pass away and they left you some assets and it was a capital asset, when they died, there was an increase in that tax basis in that asset. And if they kind of remove that provision, I think that it probably would have been a nightmare in trying to figure out some of the cost basis on some assets. It was just easier when somebody passed away and you just had like this clean slate of a step up in basis. Nowadays with technology, I guess it should be a little easier, but there's still complications with some assets. And there's been, the C corporations have a flat tax rate of 21%, which is much lower than it used to be. They were proposing making a tiered schedule change to that, and that's not going to happen.
So, Rich, doesn't look like there were too many changes then from the tax package.
Yeah, let's call it a day and just like, say goodbye. No, there are going to be some things, but I think I want to take a couple of minutes and kind of go through. You see the X there of what's not going to happen. So that 39.6% bracket for the ordinary income tax rates is not coming back, right? But what's interesting is when you look at the 2017, the highest tax bracket of 39.6% was there. For those of you, depending on where your taxable income is, these are the charts based on a married couple filing jointly. You can see that the biggest change in 2020 column, that should be 2020, 2021, is the 35% bracket, which basically, went up to over $600,000 for a married filing jointly. So those brackets really, were beneficial to certain taxpayers. And any of the proposed changes that the government was looking to make, they always stated that they were not going to negatively impact a taxpayers, making less than $400,000 a year. So you can see like the proposed changes that were supposed to happen, anything under $400,000, like under that X right there, that was going to stay the same. The changes were going to be to the over $400,000. So ordinary income tax, where you're still in the same brackets that you would have been in, no changes on the tax side. Let's go to capital gains. I guess one of the things that some of you might not even realize, and like historically, we've always thought of long-term capital gains rates at like 20%. Or at least I have, for historically they've been, for most of our clients, they've been at the 20% rate. But, in the last couple of years, the capital gains rate's been at 15% from a federal standpoint. You still, if you're in a state where you pay state income taxes, you're still paying the state income tax on top of the federal rate. But it's at 15%, which for married filing jointly goes up to about $500,000 of taxable income. So let's take an example there for a second. Let's say that, you and your spouse, make less than $500,000. Let's say you make about $300,000 a year, and you have some low basis stock. You can sell that stock and pay a federal capital gains of like 15%. So there's some bracket management there, even on the capital gains side. Of course, you also have bracket management. You have to look at your bracket management on the ordinary income taxes as well. So it's just good to see as a comparison of those capital gains rates. Just a quick point here on C corporations. The rate beforehand was much higher than 21%, but the rate today is a 21% flat rate for C corporations. A lot of our clients consider, an entity selection for their businesses, and sometimes there's multiple businesses. Sometimes a C corporation acts as a management company. Setting up a C corporation and having a 21% flat tax right now is beneficial for clients. Rule of thumb that I often use when a client's considering a conversion from a C corp to an S corp is are they using most of the funds inside of the entity to reinvest in the entity, or are they pulling it out through W-2 earnings and distributions? And if they're pulling most of the money out of the company, most likely an S corporation, with the 20%, qualified business income deduction makes sense. That's just a rule of thumb. Check with your CPA before making any decisions. On the federal estate tax history standpoint, let's take a look at, the blue graph right there. The bar chart is the estate tax exemption. That's the amount that if you passed away, the federal government says, we won't tax you on any amount below this amount. Anything above that, we're going to tax at an estate tax rate. And the red line is the highest estate tax rate historically dating back to 1997. Around 1997, it's kind of when I was starting my financial services career right out of law school. And I was working with clients, high net worth clients. And if you were a client, married couple with a balance sheet of more than $1.2 million, there was some estate tax planning that we had to do. So the estate tax exemption in 97 was $600,000. Over time, and then magically to today with some congressional action and deals that were made, we grew to an $11.7 million estate tax exemption. So that means that if you were the lucky ones, where your estates were less than $23 million, you didn't have a federal estate tax to pay. But you can see this increase from 2018 to 2021, that's That's really only temporary. I know it's not. I know I said it's not going to change in the infrastructure bill that just passed last Friday, but what it's only a temporary increase. So in 2025, it'll go back. 11.7 million will go back. To cut in half as it was in 2017. So that's only temporary.
The other thing too, they want to keep in mind, Rich, if a lot of the people that are on with us today are from Massachusetts, the state tax is pretty low, the threshold. So in Massachusetts, we actually have one of the highest, the lowest thresholds and the highest estate taxes for a state in the country. So how that works is at $1 million, the state estate death tax is triggered and retroactive to $1, and then it's progressive all the way up to 16%. So it does make a point if you're under the threshold, but you're living in Massachusetts, gifting becomes it becomes more of an option to avoid taxes in the state of Massachusetts.
That's a great point, and kind of reminds you of some other basic principles, whether you're young in the midst of your career or retired. Setting up a will and having your estate plan in order and naming your executor and your guardians, and we like to call who your decision makers are, is important. So make sure you have that step 1 done. Step 2, taking a look at all of your plans, your IRAs, your qualified plans, and reviewing the beneficiary designations. That's often overlooked and can be very complicated if you haven't updated your beneficiary designations on those IRAs or qualified plans. But what John is mentioning on Massachusetts having the estate tax exemption of $1 million, a lot of our so there's a lot of individuals who have a taxable estate in Massachusetts, and so one of the key things there is also looking at how assets are titled and making sure that as a married couple that there's enough assets in each one's name so that exemption can be used.
And that's incredible. I don't mean to beat this one to death, but that's such an important one in Massachusetts for one reason. The threshold is low, so it's triggered at a low number, and the property values are very high. So it's not that hard to have a net estate over $1 million in the state of Massachusetts.
Yeah, no, that's a really good point. Just to close out a point right here on the federal estate tax exemption, just wanted to take a minute and kind of go through the math, and so some of you might have had conversations, with your advisors about making gifts, and, maybe you're still in process, or maybe those are on hold because the changes aren't happening right now. But like I said, it's going to sunset. It'll come back, it'll go away in 2025. So from a federal estate tax standpoint, you have the federal government says if you're an individual and you have assets that are worth less than $11.7 million and you pass away, we're not going to tax you. And so at your death. And so, but that estate exemption is also a gift and an estate exemption. So that what that means is that you can use that exemption during your lifetime. So some of our clients, who were concerned about that exemption being reduced in half, wanted to take the opportunity to use some of that exemption before it went away. The way the math works is that, remember that chart where in 2017, the old exemption was 5.85 million, and now it grew to 11.7 million. It was basically doubled. So during Trump's administration, some of the tax law changes that were put into place, it temporarily doubled that federal estate exemption. So if you were to, here's the catch. If you make a gift today, you'd have to make a gift of more than $6 million to get a benefit of using that exemption. Because if you only gifted the 5.85 million, because your gift comes from the old exemption first, and then it sunsets and goes back to half of what the $11.7 million is today, you basically end up with a zero exemption remaining. So in order to get the benefit of that, you have to be first of all, you got to be able to financially afford that level of a gift and be able to make a gift more than $6 million to get that benefit. All right, so here's what did happen. Enough about what wasn't included in the infrastructure bill. What was included? So, and again, a lot of these pieces are going to apply to our higher, income. Some of them are, higher income business owners, higher, income, clients, even to the extent of super affluent. So when you think about the infrastructure bill, that they really had like a tight line of between the Democrats and the Republicans to try to get, an agreement and have things pass. So who did they go? Originally they said they're not going to go after people who are making less than $400,000 a year. They didn't do that, but they still weren't getting the agreements between both party lines, right? So they had a lot of pushback, insurance industry, grantor trusts, estate tax exemptions. So they basically went after the super affluent and some loopholes with some business owners. So the application of the net investment income tax to trader businesses for high income individuals, that's basically if you have an S corp or an LLC, and you are making over, like, I think $500,000 a year, married filing jointly, you're going to have, and that income, that business income that came from that S corporation or that LLC was not being taxed for FICA purposes. The federal government now is going to tax that at 3.8%. So that's the rate for the net investment income tax. Another point is on the 1202 gain exclusion. So if you were, if you were, let's say, for example, you came up with this great idea. It's not an Uber Eats, but it's something better than Uber Eats, right? So, and you come to John and I, and you're like, I've got this great idea, and we're about to be like financed, and this company is going to be worth hundreds of millions of dollars. And I'm like, all right, let's talk about how you're going to like set that up. Maybe you set it up as let's set it up as a C corporation, right? It's not going to make a lot of money right away, but it could in the next couple of years, really explode. The benefit there was, when let's say 5 years down the road, this company is now worth like $100 million, right? And good for you, congratulations, everyone's popping the champagne, and we're like, but you remember how we advised you to set up a C corporation under 1202 of the Internal Revenue Service Code? You're able to exclude $10 million. Yes, I said $10 million of that gain, from taxation. So that was a great benefit, and used by, and I'm not just making, like, I know I'm making it fun, but we have these conversations with our clients. These are real situations. So that exclusion of gain is still there. But they're instead of giving you 100% exclusion up to the 10 million, they're reducing it down to 50%. So it's still good, not as great as it was, but it's nice to have it, right, John?
Absolutely.
So one of the things that'll be interesting is all the money that's being funded to the Internal Revenue Service. All those complaints over the years that they don't have enough people to do what they really want to do. Well, they're getting a lot of money now, but one of the conditions is the money that they receive, is not supposed to be used from a compliance standpoint for us taxpayers that are making less than $400,000 a year. For those of us who are making more than $400,000 a year, well, you're in a different situation. There's going to be additional money for bringing additional capital and individuals and resources into the Internal Revenue Service, having them be trained on the income and the estate tax side and gifting transactions. So hold on, you'll probably see a large increase in audits, over the next couple of years.
That sounds like another good reason to work with a professional.
Yeah. Yep. Cross your T's, dot your I's, right?
There you go.
So that'll be interesting. And then you have some other changes where the surcharge on the high income, individuals, estates, and trusts. That's an interesting one. For those of you who are on Twitter, and/or been watching like the news about Elon Musk, talking about, he's got a stock option that's coming due, and it'll expire next year. So he's got to exercise that stock option, and whether he's going to, and by exercising the stock option, it's 10% of the stock. So so just to round it out, Elon Musk owns Tesla stock. He has $200 billion worth of Tesla stock holding. He's thinking about selling 10% of the Tesla stock, for the income tax liability that he's going to have. He's put it out to Twitter, to ask his followers, his millions of followers, if he should sell the Tesla stock. And so far, what I say, it was pretty close actually, but so far they, most of his followers, his minions, have been telling him that, he should sell the stock. And you know what, from a social standpoint, from a stock standpoint, what a great way to use, social media. Because at the end of the day, he doesn't take a salary from Tesla. He lives off of his earnings from the Tesla stock itself. And he's restricted as a CEO of when he can sell the stock. He's not like the rest of us who are like, hey, yeah, it's gone up 175% this year. Maybe I'll take some chips off the table and sell some of it, right? But the other thing that Elon Musk, his tax advisors that are around him and probably advising him, is that next year there's going to be a surcharge on high income individuals, estates, and trusts. That could mean an additional 8% tax on his earnings. And this is going to apply to individuals that are making more than $10 million a year. So it's not for us common folk, right? But 8%. So go back to the example, $200 billion of stock, you sell 20 billion, 8% of 20 billion, that's a pretty big number, right, John?
It's a pretty big number. It's a little.
So we'll have to see what the outcome here is, what Elon Musk actually does. But I find it to be a pretty interesting story. And then for those of you who live in, high tax states like Massachusetts, California, New York, coastal states, right? We were limited when the tax law change happened to our, to our real estate and income tax deductions to $10,000 a year. So one of the changes that is about to happen for the SALT deduction is an increase for married filing jointly from $10,000 to $72,500, which is pretty cool. So if your real estate taxes, income taxes are higher than 10,000, being able to take the deduction is beneficial. But it gets better than that too, because some of the changes that went into place years ago was they also took away the alternative minimum tax for these types of deductions. So because when you got the deduction years ago, it also usually on page 2 of your 1040, you were hit with this alternative minimum tax, which basically took away the benefit of the deduction. So I don't think that they're bringing back the AMT exposure for the SALT deduction. I could be wrong, but hopefully it's a nice holiday and a nice tax season for all of us as we go into and we see those deductions apply and we're not paying back those taxes. So we'll wait and see. So John, can you talk a little bit about, I talked about taxes. It looks like a lot of it is just affecting more of the high income, earners, but as we're working with families and clients, on their financial planning, how do you get started?
Sure. I think one of the reasons that we had this event today is that, Salem State saw a need. There's, a lot of people that need information. Hopefully you're going to walk away from this knowing a lot more about estate planning and charitable giving than you did before the seminar. But at the same time, we want to teach you how a good financial advisor starts the process, which then leads to being, a good donor. And really, the financial planning process starts with simple things like budgeting, setting some goals, understanding what your net need will be at retirement, and incorporating an idea of, from the very beginning, of necessary estate, what you're going to need to live on all the way through to the ripe old age of 95. And that's your necessary estate, what you need, and versus the excess estate. So the goal is to build as big an excess estate, money that you don't necessarily need to live your life in the lifestyle that you want. Our firm does that particularly well, but that starts at a young age. And I know we've got people attending this event that are all different ages, but I think it's, the best said by saying people don't wake up and plan to fail. They just fail to plan. And having a written financial plan, I think, certainly helps. Understanding what is a better asset to give. Sometimes something that's highly appreciated might be better given than spent down or taxed. And also, if you're older and you've accumulated assets, maybe giving the assets that are probably subject to more taxation to for your heirs who might be in a higher tax bracket could be a suggestion. So it's all following a process. When you get to retirement, do I have enough? Is it in the right places? Where do I take it from first? And then a little bit of what if planning. We call that family governance. So what happens if something happens to my wife and I? Who's going to take care of my children? Who's going to make financial decisions? Things like that. And ultimately, the cherry on top of that sundae is since they're not going to name the cafeteria at the IRS building after us, maybe doing something a little bit more substantial. Rich, can you go to slide 19 and I can expand on that?
Sure.
So the way that we look at this is, are we okay? So are you and your immediate family, are you okay? Are the first two blocks. So estate planning, like I said, life insurances are in place. I'm doing a great job saving. Maybe I could start to give, and maybe I can give the right assets. Once we get beyond, am I okay? Is my family okay? Then we start to ask the question, is my community okay? And for many of you, maybe Salem State University is part of your community. Maybe it made an impact. I know I certainly can say that I wouldn't be who I am or where I'm at without Salem State University. And, I made it part of my estate plan. Because like I said, they're not going to name the cafeteria at the IRS building after you, but they certainly might at Salem State University. And the other component to that is when you send your money to the government, you're hoping that the government does something in the ballpark of what you would like to see happen. And hey, let's face it, we all need roads to drive on, and we all need services, and we hope that the people that need the services get the services. But at the same time, when you give to a charity, you can be specific about where you want it to go. Maybe you had a nursing major or an education major and you want it to go there. You could be that direct at an institution like Salem State, but it also goes exactly where you want to go for the purposes that you want it. So that's where the estate planning comes in, naming people your ultimate demise, because there is going to be a part, as Rich just explained, of your overall estate that goes to taxes, and that's where you can make that diversion to your favorite charity. Let's talk about a path to charitable giving and what some of those steps are. We are so thrilled when we hear that people are giving, because the millennials are a very, very charitable group of individuals, and they set charitable goals early, and that's a wonderful thing. And that can grow, right? So, hey, you can give a couple dollars when you first get out of college, and you create good habits, and you make a difference, and that could grow to eventually at your retirement or in your later years, or at the sale of a business or whatever liquidation event might happen. You give a gift that's more sizable. You determine what you want to give. So, hey, what's my goal? How much is that going to take in today's dollars, and how do we get there? Maybe that's through some wise investing. Maybe that's through growing a business. Maybe that's family legacy money that you want to maybe make a difference at a place like Salem State. Then you decide when. There's a saying in our industry that it's always better to see what you give, right? I mean, It's just something to see the effects of your hard work and your charity while you're living, right? Or you can make it a legacy gift and be part of the Crosby Society. And at your demise, you can then fund something. And then you decide how to give. There are efficient assets to give, which means if you give them, the charity can do more with it because of their tax status. So if you give an IRA or a retirement plan, or if you give a highly appreciated stock, that might be more efficient, and you get more dollars to the charity on dollars that otherwise would have been taxed in your own personal situation. So decide how best to give. So it's those are the steps that we use in making someone a better donor.
They're great. And, we try to make it simple, just follow that 4-step process. I'm going to take each one of those steps and just kind of add a point to it. So in reference to, it really just starts establishing those charitable goals. And clients kind of fall into, 2 different spectrums, whether some of them are just like full on it's about the charitable contribution, and others are, want the charitable giving component of it, but really want to know what's the best way from an income, from a tax saving standpoint. And so we approach it, with, both of those points, and kind of guide it depending on the type of client that we're working with. The easiest way to give money is cash in hand, right? So giving cash to charity is easy, but sometimes there's a better asset, right? Sometimes it's that low basis Tesla stock that appreciated by 175% this year. So maybe you have, $10,000 worth of Tesla stock, and good for you. That was a good decision to purchase that when you did. And you say, I have some charitable desires, and you give that $10,000 stock to charity. There's some AGI limitations, adjusted gross income limitations, but with stock to charity, it's about 30% limitation. So $10,000 gift, to charity, you basically get a double tax benefit. You get a deduction for that gift, and charity receives the low basis Tesla stock and does not pay any taxes because they're a tax exempt entity. So that totally makes sense. Some of the other, points to kind of consider is that this year, with a cash gift to charity, you can basically gift up to 100% of your adjusted gross income and get a deduction on it. I think that goes away after this year. So when to give, one of the things to kind of consider is during your lifetime or at death. So during a lifetime, you give directly to charity. You can set up tax strategies with using different trusts that, we're not going to go into the details today, but like CRTs or charitable lead trusts, each have like a different purpose, like tools in the toolbox, right? But it's the first thing to kind of understand is what your goals are, who you're looking to benefit, and what type of asset that you're looking to give. A gift at death, the easiest way to give to charity at death is honestly is through a beneficiary designation of an asset like an IRA, your individual retirement account. And why is that? Your IRA is always going to be, the distributions from that traditional IRA will always be subject to income taxes. Some of you might have the good fortune of having, or good misfortune of having to pay estate taxes. So IRAs is the type of asset that's subject to 2 layers of tax. Consider the estate tax rate at 40% and your individual income tax rate at, I don't know, make up a number, 35%. So it's a combined rate of somewhere around, with a deduction, maybe it's like 65%. So take $1 million IRA, that could, have like $600,000 to $650,000 in, taxes applied to it when you pass away. Go into the beneficiary designation, naming Salem State University or another charity as the beneficiary of that IRA. Salem State gets $1 million. You might work with your financial advisor and transfer some other assets over to a trust, so you get the growth out of your taxable estate. And that's to kind of offset some of the assets that go to charity. there's ways of having everyone kind of win, except for the IRS. So some good planning basically reduces down the money that the IRS receives, increases the charitable contributions, and increases the wealth that your family ultimately receives. So we talked about, some of these gifts is, 2021 giving cash directly to charity. You get 100% up to 100% of your AGI deduction. Low basis stock, great asset to give to charity, especially if you're looking to diversify out of your portfolio. Transferring that to charity and receiving a tax deduction, and not paying the gains on the liquidation of that asset. IRA beneficiary designation or 401k plan beneficiary designation at death, part of it, or all of it to a charity like Salem State totally makes sense. Some of the vehicles that we use for charitable planning, direct gifts to charity, obviously. Charitable Remainder Trust and Charitable Lead Trust, talked about those before briefly. Charitable Remainder Trust is a nice way of smoothing out income over time. But the more popular ones is a donor advised fund, even more popular than a private foundation these days. They're very cost efficient. It's a way to basically get a tax deduction today, control the giving over time, to charity, and keep the control in your hands, but have somebody else kind of manage the tax exempt entity like a donor advised fund with different custodians that we've worked with and setting those up. It's very easy, much easier than a private foundation. So remember 4 steps considering a charitable gift. It's as easy as 4 things. Understand your charitable goals, determine what to give, decide, when you're going to give it, and decide, how that gift is going to be accomplished, what vehicle. So I just want to take a minute before we go into our Q&A. And I'm sure, you guys have some really good questions. Just to say thank you for taking the time to let John and I kind of talk to you about, charitable giving, talk to you about, Salem State, and talk to you about the, where we are in current tax law changes. So I appreciate it. And thank you for your, for being thoughtful and making charitable gifts, because, that's what makes organizations continue as best as they do. Thank you.
So thank you, Rich. And maybe Brian could come on and join us. Hey, Brian, you're on mute.
Yeah, I should have had that sorted out in 2020. Sorry about that.
That's all right. No worries.
Thank you both so much. How terrific. And those changes are timely. And also so relevant to all of us. And I just wanted to echo what you were saying, Rich and John, and how you lay out the thoughtfulness that goes into the planning. And that's how my team and I approach this too. We're having these thoughtful conversations with people who are, perhaps looking at end of life, financial decisions. And so we're just so grateful to have people include us in those conversations. And the part of telling us that this is happening through your estate plans is that we can work together, to your point, Rich, of what is that do you want it to have happen here at Salem State? You so thoughtfully included us, but what does that mean here? And including you in that conversation so that it's not, say, a surprise that you're passing. We have bequest language on our website that you can find, or if it's a beneficiary designation, just letting us know that you have those plans in place, and we can talk through what most excites you here and how you want to see that gift in action. So thank you. And we did have a question. I know you kind of hit it on it there a bit ago, Rich, but just to reiterate, the question was, what is the easiest way to include Salem State in your estate plans? And I heard you say beneficiary designations, and I think you're right in terms of going online and our accounts and things. So I don't know if you wanted to add any more context to that, but that was a question you answered, so I will acknowledge that you answered it.
Well, I think it's easy and it's tax efficient. So it's a great asset, a great way to accomplish your charitable goals. As part of your estate plan.
We talk about that necessary estate and that excess estate. We want to make sure that we pass on or we donate the more efficient assets, the ones that I'm sure the least efficient assets, and keep the ones that are more tax efficient. So the IRA is a fantastic option.
That's great. And another question that came in too was the balancing of, and your pyramid spoke to it well, I think, was just the balancing of the family kind of needs or wants of heirs and the philanthropy. And before I throw that over to you in terms of what kind of, balance that might play out in those family discussions, I guess that's what I suggest to people baseline it, is just have those discussions, have those conversations, let your family know what you're thinking and why you might want to support Salem State. But do you have any kind of examples for families that you've spoken with as they think through those processes as a unit and come to those decisions together?
Sure. You know what? I think that one of the success stories, and we see this a lot, right, Rich, that sometimes you could do both. Back to my earlier point where they're not going to name the cafeteria at the IRS building after you. You're giving to a charity like Salem State lowers your overall estate size. It also is an efficient place to give. So you're going to pay taxes. It's very hard to get to a net zero estate death tax situation unless you're way into the thresholds, in which case you're probably more thinking about preservation of your wealth. So I do think that there's a way to do both, and a way to do both together. And if it's a charity that's as important as Salem State might be to many of the people here today, a good financial advisor should help you navigate that.
That's great. That's great. Thank you. One question from the crowd. Yeah, please, Rich.
Sorry. It's so one of the things that I've seen with clients, I'm actually working with a family right now, is in a situation where it's a substantial net worth, and there's and the children are basically in their late 20s, early 30s. We're starting to get into the conversations of the assets that are there that are available, that which they know about some of the assets, but not the whole net worth. And it's bringing the family into the loop, having conversations. And one of the things that's coming out, from the children, who are very thoughtful, is they're a little overwhelmed as to the level of wealth. And, and they wanted to make sure that they had options for like charitable giving that were even in some of the trust structures that we set up, so they could be more philanthropic. So it's, you never know how the conversations kind of go. Each family is going to be a little different, but just having those conversations, is important.
That's great. Thank you. We have one more question from our attendees. The question is, are you seeing your clients increase their giving this year in order to take advantage of tax laws, especially as it relates to deducting up to 100% of adjusted gross income?
Yeah. So, you know what? So I always talk about the cash gift, 100% adjusted gross income. I personally, like, for example, clients, making like $500,000 a year, giving I haven't had a client use the full cash for the amount of income that they earned this year. So it's, but they have increased their cash gifts. I've actually had more clients are doing low basis, stocks as, gifts, either directly to charities or establishing their donor advised funds, with taking deductions in high tax years, especially if you have a large capital transaction like selling a business or some other
selling a big stock.
Yeah. So I think honestly, it's just the more conversations that John and I have with clients, whether they're younger or more mature, the higher level of charitable giving, because it kind of comes back to the complexity and laying a plan out in place. And John and I are holistic in how we approach it, and kind of like having an understanding of where you are and where you're going to be from a financial planning standpoint helps you drive those decisions.
That's great. Well, I know
we
we're
have to
running.
remember one thing, that right now we're a consumer-driven economy, and we've all hopefully taken advantage of lowering the interest rates on any loans that we have. Americans have more cash in their pockets than they've ever had because we just came out of a year that we didn't spend all that much. And then lastly, their account balances and their investments are through the roof because the market's been good to us. We don't know how much longer that's going to go on for. However, that's where we're at. And we are seeing that people are more philanthropic because of that. And it's as good a time as ever to give. because of those facts.
That's great. Such thoughtful insight. Thank you both so much for your time and your wisdom. And thank you all for joining us. And if you have any questions, a member of my team or myself will be following up and happy to answer any questions and just kind of explore these ideas and have this thoughtful conversation continue. So thank you all so much.
Thank you.
Thanks for having us, Brian. Thank you, everyone.
Of course.